Good afternoon. This is a webinar for tax planning strategies for individuals and businesses being held by Akram Assurance Advisory and Tax Services. The panel is Steven Rosen, Muhammad Akram, and Shyama Nair. My name is Jackie Jones, and take it away.
Jackie,
One more very pertinent, yes, one pertinent thing I must add is that CPE credits would be given if 4 of 5 questions within 50 minutes of you participating, you'll get the CPE credits and the certificate within, I guess, a week or 4 to 5 business days to a week. Okay.
Okay, awesome. Thank you.
Thank you so much.
Thank you, Jackie. Let's get the ball rolling because we have to cover a lot of ground. So we will having 2 webinars regarding tax planning strategies for individuals, businesses, and hedge funds. So this will focus primarily on the hedge funds, and we will have also the management companies and the small businesses in addition to the high net worth individuals, right? So today I have a wonderful my team with me, Steve and Shyama. They are going to help me out to start this conversation. So as you guys know, we are a big firm specializing in hedge funds, private equity, venture capital, and we provide accounting, audit, and tax services to all the alternative investment entities. And we have a headquarters in North Carolina, but we have offices in multiple locations and outside the US. And let's start the conversation on the tax planning. In order to saving income tax for the current and the future years, tax planning can reduce eventual estate taxes too, right? So that would also reduce the cost of financing your children's education, also help you for the retirement, and also manage cash flows to meet your financial objectives. So purpose here is that we want to reduce your current year tax liability. We also want to defer the current tax liability to future years if we see that increasing the cash availability for your investments, businesses, or your personal needs. Tax planning can also help to reduce your potential future tax liabilities and maximize tax savings by using all the deductions. So it can also minimize the effect of alternative minimum tax for this year and the future years, and also minimize by taking the tax advantage of all available tax credits, right? Okay, so let's start that. Hedge fund, right? So Steve, I'm going to ask you because this is the area where I think we struggle. Or Shyama can chime in, right? If it is more relevant to him. Tell us about the constructive sales and the short sales and how we can help the funds to do some estimates so that they're not getting a surprise at the year end when they receive the huge capital gains. Especially this year is very important because most of the fund lost money, and if the K1s are showing them capital gains on their K1, investor will be not very happy to see those K1s. First they lost money, and at the end you're also giving them the capital gains on their K1. They have to pay taxes. So go ahead, please, Steve.
So I assume that what you just described, you're trying to tax harvest for wash sales, right? You want to make sure that if you, right, I would assume that's what you were referring to first. So if you're doing an analysis of your portfolio and you happen to see that, you know, in the overall, as it stands, you've got some pretty big realized gains, but you've got some unrealized losses sitting in there. Right. You might want to sell those off to net off against the gains, right? That would be the first thing.
Means what we call this term as harvest losses, right? You are
Loss harvesting, right?
Right.
Yes.
Go ahead.
Okay. The other thing is, like you were describing, I'm just going to say, way back when, what you're considering constructive sales today, we used to use the term boxed positions.
Right.
Right. So just for argument's sake, if you had IBM sitting in your long portfolio and you bought it at $10 and today it was worth $100, and you wanted to lock in that gain, you would take the same position in IBM on the short side.
Right.
Right. Which means you had exact same position, exact same amount, and you would essentially lock in that gain. Right. You assuming you didn't sell anything. Right. That was the objective. So what the IRS said is, no, you can't do that anymore. I think that was back in, oh my God, I think in like the late 90s, right? They kind of cut that off, right? They said you can't do that anymore. If you have that situation, they're going to make you recognize it as if it was a real sale, and they're going to make you pick up the gain. The biggest, exception to that rule is if you happen to close that position in some time in the month of January, right? You have 30 days from year end, so basically the month of January excluding the last day, and hold that position for 60 days, it will not be a constructive sale. Right. So in that case, what you've essentially done is you were able to put the gain in the year that you wanted it to, which is what the IRS doesn't want you to do. Right? They don't want you to transact. They don't want you to have the ability to move either gains or losses from one tax period to another. They're ultimately trying to get everything into the same period. And that goes for, they want to accelerate gains and defer losses. And obviously you want to try to do the opposite.
And that's a very good point, Steve, you brought that. IRS wants you to defer the losses and accelerate the gain. And the taxpayer exactly wants the opposite. So all these tax provisions, constructive sales and the war sale and the like the straddles, you guys will determine that they want to defer the losses and they want to accelerate the gain. Okay.
Right, and this goes to the fact that especially the bigger funds, their tax bills for whomever their tax person or firm is can get relatively high because they're doing this analysis for wash sales, straddles, constructive sales. They're doing tax testing all year round to make sure that everything is classified properly. Right. So, if you have a big portfolio and you're doing tons of trades, it becomes a pretty hefty bill.
Right.
But that being said, if you're working hand in hand, you can sort of offset the cost of that bill by reducing the tax that the investors are going to have to pay through their K-1s.
Absolutely. There's always value to that for the detailed tax testing and using those tools. Okay, so regarding the short sales, I think usually every realized gain loss can happen on the trade date basis, but for the short sales, if you want to recognize the loss, you have to cover the short in December, means the transaction will be settled in
It has
December.
To be closed by the last day of the year.
Of the year. Okay, so let's is this treatment of fund expenses? Who is going to speak on that?
So fund expenses, this came more in the focus after TCJA, wherein the trader and investor status became more of importance. So prior to TCJA, everyone was allowed to take a 2% deduction of miscellaneous in form of portfolio deductions. So investors could also take a management fee or admin expense deduction. But since TCJA, they suspended the 2% deduction and from 2018 to 2025. So basically the trader expenses are above the line, that is before. So for determining the AGI, they can deduct these expenses as their business expenses, ordinary trading expenses. But as an investor, it is basically a below the line, that is after your AGI, and no longer from 2018 to 2025 you can take this because this is suspended. So.
Right, awesome. Okay, so regarding those capital gains and losses, what the tip 2, 3, and 4 we're trying to mention here for those someone has capital gains?
So for this, when you're anticipating that the tax rate is going to go up in the next year, or if you can see some kind of a future taxation going up, you can definitely like try to accelerate your income or accelerate your deductions in your current year. And similarly, if there is something which is going to benefit you in the future years, you can try to defer your income from this year to the next year. So the timing of income and bunching of expenses, deductions can definitely help you to change your tax liability. So the more can be given in the next slide for this.
Okay. Oh, so before we go for the slide, I think let's do the polling question the first. Let me launch the polling question here quickly. The polling question is, what are you hoping to learn more about today? So we are waiting for the responses, but I believe we have got most of that. So I would say 38% said they want to learn about tax planning for individuals, 50% said tax planning strategies for hedge funds, and 13% said for the businesses or management companies. So seems like it is a very balanced, diverse participants who wants to learn different things. Okay, so this is the tax planning exactly for individuals we are going to target now. So this is a situation, and this is the planning idea we can recommend you. So Shyama, would you tell us overall?
Yes.
Right. So just before you go, just let me say one quick thing on this is the overall. Sure. This leads really back into what I said earlier about accelerating income and deferring expenses, right? That's what most of this is built around, whether you can accelerate the income or defer the income, or accelerate the expense or defer the expense. Right? That's what this is all about, taking into consideration current tax rates, projected future tax rates, and the potential AMT.
Right.
So I just wanted to, make sure that everybody got that idea that it's basically the same as we talked about, just specific to individual.
Correct, Steve. So that is what basically the regular tax rate and the AMT being the minimum tentative tax rate. You definitely want to take a look on those aspects before deciding whether you want to go for basically want to recognize income when it hurts you the least. And so in that way, you, in case you see that the regular tax rate is going to be lower next year or going to be the same, you would rather want to defer your income for the next year. So say you can take a year-end bonus in the next year when it's going to affect you lesser. You can being a business, if you're in a business, you would want to get your receivables, collect from your receivables later in the year or next year. You want to defer that income. Similarly, you want to prepay your deductions. In that sense, you want to prepay your taxes or other similar insurance payments or such expenses which you can take a deductions on your tax return, so that it hurts you less this year when your tax rate is much higher. And similarly, the situation 2, 3, and 4 is talking about opposite kind of scenarios where the tax rates are going to be lesser, increasing next year. So in those cases, you definitely want to defer your deductions for the next year. And so you would like to do more bunching of deductions for your next year. And similarly, you would want to decrease your income for the next year. So you want to definitely get those income this year more. This is what the slide is talking about.
Okay. Awesome. I think let's touch some the realized gains and losses. I think the main theme is that if you have during the volatile market, somehow you were forced to recognize some gains. So it is a time that you can recognize some losses before December 31st to offset those gains, called harvest losses. But when you do that, please make sure you understand the wash sale rule, and you will not fall into the trap of wash sale. Otherwise, IRS will not take you to deduct those losses and will not achieve the objective of recognizing those losses in this year. And I think the other main point for that estimated taxes. So a lot of people, when they come in to us and file the tax return, they always think they have to pay taxes on April 15. April 15 is not the day, because if you are self-employed and you're making an income during the year, the system is pay as you go, means as you're making the money, you have to pay the estimated taxes. So they divided the tax year into 4 different quarters, and you have to pay the taxes at different, but the last payment date would be January 15. So make sure you're making your payment by January 15 to avoid interest and the penalties on that. And other is that you will be subject to 3,000 loss limitation rule for all the taxpayers individual, even if you have more losses.
Muhammad, can I ask a quick question about estimated taxes?
Sure.
Right. So the estimated taxes apply to both federal and state, right?
Yes.
Would you make so if you're in the position where you need to make estimated tax payments, would you make the last estimated state tax payment, which is technically due January 15th, would you make it December 31st to pick up on your federal return as a deduction?
Right. Yes, that was a very good point. Most of the taxpayers were doing that before the SALT cap of $10,000.
Yes.
Now that you can't deduct anyway more than $10,000, so there's no real benefit of doing that.
Right. Correct.
But in the past, before the TCJA, people are doing that. Okay.
Right.
So,
and if TCJA goes away or doesn't get renewed, then you're back into that position.
True. I think that will sunset sometimes in 2026. Those
right.
Okay. So and then overall is that short-term capital gains tax at the ordinary income tax rate, which is 37% highest, and then you will pay 3.8%. The long-term capital gains tax rate tax at 23.8, 20% highest long-term gain rate, and then 3.8 is the net investment income tax, right? So these are the maximum. So always we suggest clients to hold for a 1 year to recognize that gain, because there's a huge difference between that. And also it brings to the question of qualified dividend and the ordinary dividend. Ordinary dividend also tax at the ordinary income tax rate versus qualified will be maximum at. In order to get the qualified dividend tax treatment, you need to hold the stock 60 days before the ex-dividend date of 120 days. So these are the good tricks. People can reduce their taxes because if they hold for 1 year and if they hold the security before the ex-dividend more than 60 days, they can get qualified dividend and they have to pay the lower tax and can help the overall effective tax rate. Okay, so this is more for Shyama. Can you please tell us about these deductions, expenses people can prepay and can help them out in certain cases?
Yes, so in general, IRS does not allow like if you prepay expenses as a deduction, but there is a 12-month rule where you can like take deductions if it is within the 12, if you're prepaying and the rights is within like the next 12 months. So for example, I'm talking about like property taxes, state and local income taxes. So these are the taxes which are capped at $10,000. And if there is a refund of a salt, if of the state and property, state and local tax, you can, it is taxable if the refund, if you took an itemized deduction in the last year. Secondly, for charitable deductions, if it is through cash, it is 60% of the AGI. Similarly, we have other caps based on the kind of, if you're given appreciated property as a charitable contribution, everything is capped for like 20%, 30%, or 50% of AGI.
Right.
So that is something that can be considered. Then medical expenses, that is something which, if there is an expenses exceeding 7.5% of the AGI, that can be considered. Then mortgage interest. So mortgage interest on the first 750,000 of the loan, you can deduct the mortgage interest. And if the loan is before December 2017, the limitation goes to a higher level of 1 million. And also you can also deduct points paid, but there are certain guidelines for which you need to follow, but that is also a deductible portion of mortgage interest. Margin interest is only allowed to be deductible if you have an investment income in front of it. Like it needs, there has to be an investment income for you to deduct margin interest. Margin interest basically being you investing into stock using the borrowed money from your stockbroker or similar. Business equipment, as Muhammad said previously, this is section 179. Which allows you to take 100% deduction for a qualified property in the year that you put it into service. So that is definitely which can be considered and can help accelerate your deductions.
Right. So I can give you here a scenario which is quite comes often to us. People wants to contribute security to the foundation, their private foundation, or any other charity, and the security has huge unrealized loss. Should they do that or not? What is the best strategy Shyama and Steve think they should do during that? What would you recommend them?
So appreciated property, there is obviously a lower deduction limit based on the percentage of AGI.
Right.
But you get there is no capital gain tax for now.
Right. So we usually recommend in that scenario, if you have a security and you have an unrealized loss and you want to contribute to the charity, we suggest don't do that. Recognize a loss, take a deduction, and contribute the cash. Right. But
Correct.
it would be better to contribute towards your Roth IRA, right? If you have a huge security and there's huge unrealized loss, and you want to transfer that because you know that in the coming years, just like this year, all the growth stocks got hit because the Federal Reserve was increasing the rates, right? They were reduced by almost 70–80%. It is a good time for you guys, for those taxpayers, if they have those stocks in their portfolio. I can give you one example. Suppose Meta, right, reduced 60–70%, Snap, right, this is a good opportunity for you guys if you have in your portfolio and you don't want to book a loss and you also want to convert to your Roth IRA, that's a better option. Other is harvest loss. These are the things case by case basis. If you give us a scenario, we can strategize for you what is the best way to do the tax planning for you. Either make a charitable contribution, either convert to the Roth IRA, or harvest loss reduced to taxable losses. But it depends on each factor and circumstances, and then we can advise what is the best for them. Okay. Similar case with the income. Shyama, would you tell us a little bit about that?
Yes, similar case with income. You want to accelerate income if you're expecting the tax rates to be lower this year and next year it's going to be higher. So you want the income to be recognized this year. So as it is written, cash salaries or bonus. So year-end bonuses, you can definitely get it this year, and or if you had to suppose defer the bonus, you could also do that for the next year, because your employer can still take a deduction within 2.5 months after the year end on his tax return, and you also can defer the income that way next year. So it's both the ways. Similarly for consulting or other self-employment income, if you have some kind of a receivables and if you're following the cash methods, for either case, I'm talking about if you're getting the cash method, if you're following the cash method, then you would want to get to accelerate the payment from your receivables from this year. And similarly for installment sale income, you would want your debtor to pay up this year, or you can sell off your installment note to a third party and accelerate the income in the current year. For the sale of principal residence, again, the same way. You can, if you see it's an appreciated property, you would definitely would want to accelerate the income by selling it off this year. For watch sales and constructive sales, as Steve has mentioned before, so constructive sale being appreciated financial position with a equal position on the offsetting financial position, and the only exception being a closed transaction. But apart from that, you would want a constructive sales to accelerate your income this year.
And the watch sale rules, keep in mind, applies to investors only, but the traders who made the valid effective mark-to-market 475F, watch sale rules and the straddle rules, constructive sales will not apply to them. So in certain cases, we recommend our clients to make that election, whether they're a hedge fund or whether they are a trader. Okay, so bunching deductions for individuals.
So again, like bunching deductions, this is just timing your deductions in such a way that you get higher deductions in the year you want to take itemized, and then lower your deductions in the year you want to go for standard deduction.
Right. So what happened that there's a little bit history behind that. Before the TCJA, standard deduction was lower, and every medical expenses or every charitable contributions you were made, you were able to take a deduction on Schedule A. Now they have increased the standard deduction. So we, after TCJA, it makes sense to bunch. If you want to give charity, instead of spreading out 4 years, just do it 1 year, and it will help you to reduce your taxes, because then it will Schedule A deduction will be higher than your standard deduction and reduce the rate. It's same contribution medical expense. So let's year-end withholding for an estimated tax. Some mostly our clients are not W-2 employees, where it is very easy. If the income is increased or salaries are increased, the bonuses, they will adjust the withholding. But it's more for self-employed people. When they having more income, they need to increase the withholding, and in some cases, just keep in mind that last year we issued them, a lot of them, estimated tax schedule that they need to make those payments based on the last year. Last year was a good year for most of the taxpayer in the US. Why? Because the economy was doing great, but also the stock market and the bond market was performing exceptionally well. This year, they are not doing. And if they made those estimated tax payments, which I think they shouldn't make further the last tax payment if they think that they have losses this year. So there's no point of making that, because that estimated tax payment schedule is based upon the last year of your income, and this year if your income is lower, so you need to adjust your withholding accordingly. Passive losses. Yes.
One question. So if, again, as the slide said, if you think you're going to have an underpayment penalty, right, and you're getting, let's just call it self-employment income, would it be beneficial to you to put the income in certain periods if possible, right? Instead of spreading it out over the let's say 4 quarters evenly, if you earned more in quarter 1 than you did in quarter 4, right?
So there are different methods, but one of the method we use in our software is called annualize method, which really spread the income and reduce overall interest and the penalty for the taxpayer. So that's a very good point. You brought it here. Yes, we have another 27 minutes, so we need to cover a lot of ground. Passive losses. Yes, Shyama.
You were going to speak about this one.
Okay. Passive losses is like, overall, the concept is active income versus passive income. Active income, that you're actively participating, and the passive is you're not making any effort to make money. Money is working for you, and you're not actively involved in any of those. For a normal person, taxpayer, the rental income would be passive. But if someone is a real estate professional or real estate agent or having some rental property business, then it won't be passive, right? Depends upon facts and circumstances, right? So just usually the interest income for most of the taxpayers would be passive income, dividend, passive income. But for the banks, it won't be passive. So what they're trying to say here is that if you have a passive losses from the business and which you did not materially participate from these activities, it's better to dispose those activity, because tax saving can be significant since all the losses become deductible when you dispose the activity. So that is the point they're trying to make it here, that even though it's passive activity, but when you dispose that activity and you have incurred a loss, it will not be a passive loss. And if there's a gain on the disposition, you can receive the benefit of having a long-term capital gain, which taxed at 23.88%. Okay, next time to the next polling question. Okay, the question was that long-term capital gains taxed at the maximum 23.8% tax rate. Majority of the people said yes, but some says no. But the correct answer is yes. Okay, estate planning. So this is another area where it really is more relevant to the very high net worth individuals whose net worth is exceeding more than $20 million or $20 to $25 million range, and they can do certain things between now and before December 25, because in 2026 these they will go back to the earlier TCJA changes, which was quite lower. Overall, you are allowed to make tax-free gifts up to 16,000. Married people are allowed to 32,000, but for this year 2022, it would be higher amount. I believe it would be around 17 or 16,500, but higher amount for 2022. What we mentioned here, 16,000. But by making these gifts, you can transfer substantial amount of your estate without using any of the basis exclusion amount, which is quite good way to reduce. Every year you should be contributing this gift to lower your estate. And at this point for married couples is 24.1 million, but for single is 12.6, but it will go back to before TCJ, which is around, I think, around 5 or 10 in that range, 6 to 12 in that range. So there are a lot of things you can do now to transfer wealth, and these state taxes are quite higher. They really extremely high. So forget about we are worried here paying an ordinary tax rate of 37%, but 37% tax rate starts, income tax rate starts after $1 million. But here with the below 100,000 figures, you will be paying crazy taxes, very high tax rate for the estate taxes. So make sure you're doing things right. Second is for the business owners that keep in mind that most of the business owners will be better off having a cash basis of accounting rather than accrual basis of accounting. But in certain cases, you have no options. If you meet certain criteria, you have to follow accrual basis. But if you are a small business and entrepreneur, it will be in your best interest to do the cash basis of accounting. In that, you can always like defer income to the next year and accelerate the expenses and deductions. That's the best way to reduce your tax liability. So that is always be careful about that. Just to give you an example of our accounting business, that I usually pay most of our bigger expenses in December for the next year, so that way I can reduce my, could be some marketing, could be some IT things I would like to pay in December to reduce my overall income or the overall income of the business to do that. Business equipment. Steve, would you shed us some light on that 179 and how much it will be beneficial, because you have your own small business too, right? So you might use this thing for that.
Yes. So there's this provision that's called Section 179, and depending upon the type of equipment that you buy, you may be able to basically take a full deduction for that equipment placed into service in that year. So just for argument's sake, you own an auto repair shop and you bought a a tire hammer or whatever it is, a tire rod, and it cost you $200,000. I know it doesn't, but I'm just using it as an example. Because of this 179, you very well might be allowed to just fully depreciate that 200,000 right off the top, giving you a bigger expense. Now, obviously, that's gonna change, in 2025 and 2026 with all the provisions possibly going away. As it stands right now, I believe it's almost 1.1 million of property placed in service, but can exceed 2.7 million. So once you reach the threshold of those two combined, you lose $1. It's phased out dollar for dollar. Right. And so there just comes a point where, the government's willing to give you a hand, and then they kind of just stop. right? And that number is almost $4 million. So if you have some big equipment purchases that need to be made, IT infrastructure is probably one of the bigger ones today, right? In any way, shape, or form. If you do it now, you possibly get the benefit of writing it all off and taking a huge deduction for your bottom line, as opposed to paying it to Uncle Sam. Uncle Sam's paying you for it.
Right. So the other thing is that the bonus, and the difference between the bonus and the 179 is 179 is more on the new equipment property. The bonus could be on the old property, or but the bonus percentage is getting decreased and starting beginning in 2023. So this is the last year, probably 2022, that you can get some bonus depreciation, but it will be decreased. Other I would mention that I believe 2022 is the last year to get the meals 100% deduction. In entertainment was always a disallowed, but it will go back again to 50% deduction in 2023. So so keep those things in mind, that meals deduction, which came during 2020. Right, so we were able to deduct 100% meals, but now I think it will go back to original 50% deduction, and entertainment is not allowed. Okay, business interest. So this is more like that if you have a debt that can be traced to your business expenditures, right, including debt, and you can deduct above the line. So most of those business interest deductions are allowed, right, as long as they are used for business purposes. But sometimes the credit cards fees may not be allowed. So make sure that you are differentiating between the credit card fees and the business interest. Business interest.
Right, you're talking about more financing big purchases for the business.
Right. Okay. So QBI, this is again the concept, qualified business income deduction, and I can give a little bit history, and then Shyama can tell us what happened. That when the TCJA during Trump first 4 year, he gave a lot of benefits to the big corporation. They have reduced their taxes from 37 to 21%, and everyone was complaining that what's for the Joe and moms and pops businesses, right? And that's what he came up with, the idea of qualified business income deduction, that these small entrepreneurs can get the deduction 20%, but there is here specified services. Shyama, would you tell us a little bit more in detail that what is 20% deduction here for the QBI?
So the 20% deduction here is calculated on base of two terms. It's on W-2 income and or the unadjusted basis of the assets, based on which the 20% calculation is done. And as you mentioned, yes, SSTB, specified service business, and qualified business income. These are two below the income, below the AGI deduction. It is a deduction which is after the AGI, right, which is there on the tax return. Yeah.
Right. So, but there was a concept that if you having a business based on your skill set, there's a limitation to the QBI. It means if you are an engineer, accountant, doctor, attorney, architect, and you are running a small business, this deduction will phase out to you if your AGI, direct filing joint, exceeding more than 350 or something. It will start phasing out around 200,000 somewhere, but it will completely phase out that deduction around certain threshold. So keep in mind that a lot of business can plan for that, and this is for the sole proprietors and also for the pass-through entities. They are eligible to get that QBI. Okay. PTET. This is a new concept called pass-through entity tax, and there's a history behind this. What happened that under the TCJA during Trump's first term, he introduced that he wants to penalize the high tax states, New York, California, New Jersey, right? And they want, in order to penalize what they put that under the itemized deduction, SALT deduction was only limited to $10,000. And if you're a resident of these high tax states, you would imagine that you would be paying hundreds of thousands of figures in property tax and the state tax before you were able to deduct, but now you are not able to, right, after the TCJA. And in what they come up with the idea of these states, because a lot of residents from those states were moving out. They were going to the low tax states or zero tax states like Texas, Washington, Nevada. That's where Arizona has some income tax, but that's where the migration was happening. I think it was accelerated after TCJA and the COVID. And they wanted to retain high net worth people too, because they need their money to function their government. So they come up with the idea of PTET, pass-through entity tax. And Shyama, can you give us some light on that, or Steve, any one of you, that how is it relevant for even from some emerging managers if they are operating from those states?
Right. So all that you're doing there is you're creating an entity and making an election to pay the tax at the entity level, and in turn, either you're going to be able to reduce. You're going to be able to, that tax that you pay is going to reduce the income on that entity, and if it doesn't reduce the income on that entity, you'll be able to offset it against any distributions, your distributive share for the state, for that particular state of AGI. So in either case, you will get a benefit for it. Just one is a better benefit than the other, depending upon the state. Each state has its own rules around where they want it reported and how they treat it.
Right. So there are total 29 states who came up with the idea of PTET, and every state rules are different. We heavily work with California, New York, New Jersey, and you have to make a election at a certain date and time. It's the elections you need to make every year, and you have to make those estimated payments on time. Sometimes you can carry forward in some states you can't carry forward. But whatever taxes you're going to pay at the state level, you can deduct that at the federal level, but also what you're paying at the state level can be used as a credit on your personal income taxes. So Shyama, did we miss anything on PTET, which is important to our?
No, that's correct. So this needs to be, the election needs to be made in advance. It cannot be made after the year has lapsed. And yes, for each state, the due dates for making the estimated tax payments are different. And for resident partners and non-resident partners, also the tax treatments are different. So that needs to be considered while making the PTET elections.
Right. But this is a good workaround against the SALT deduction of $10,000, and it is quite popular. Most of our clients are trying to utilize this option for the emerging, right? So let me go to the next polling question. Okay, this polling question was that basis exclusion amount will sunset at the end of 2025, reverting back to maximum BA in effect before the TCJA. And majority of the people, 100% said yes, which is correct. So we have another 10 minutes, so we need to go quick. Estimated tax requirements. What is the rule? Steve, can you tell us on the tax planning action items?
The rule? Well, yeah, you're talking about if you've you're talking about estimated taxes, basically a pay-as-you-go. But
Right.
but if you're doing some tax planning towards the end of the year, let's say November-ish, and you see that you've met 90% of the estimated tax due that you've already paid in, you may be able to avoid paying anything extra, and you would not get hit with the underpayment penalty. Right. So, and again, this goes back to if you have a good tax planning partner available to you, and especially if you've got, if you have a whole bunch of self-employment income and you're not getting a W-2, it's probably one of the best things you can do is to do that test to see where you fall out. This way, if you need to pay in more or not pay in anything.
Right. So the idea is that that you have to pay some taxes, but here is because most of the people we deal with, they rely on capital gains, they rely on the trading with the stock market and the bond market, and if they're making those estimated tax payments based on the prior year, I believe I'm just repeating it again that that may not work well. Why? Because if they have huge realized losses this year, right? So just keep in mind, but I think it's always good to work with your tax preparer, give him the full picture before December 31st, so at least you can make any additional payments you need to make before the due date is January 15, which is around the corner. Okay, but you can adjust your withholding if you're W-2, but if you don't have W-2, then you can withhold tax from pension, IRA tax distribution, and all that, right? Yes, as we discussed, that we can eliminate or mitigate the underpayment penalty by using the annualized income installment method. And it's not only the federal level, this is also comes at the state level. If you owe taxes, especially in the states which are very high tax, so make sure you are making those payments over there too. Okay, so so these are the overall the tax advantages for businesses, right? Which we have covered earlier. So NOL, net operating loss deductions. Before 2000 through 2017, before I believe the TCJA, you could carry back 2 years and forward 20 years, but the TCJA limited the deduction to 80% of taxable income, repealing the 2-year carryback. You can't carry back anymore, and only allow the NOL in tax years beginning after December 31st to be carried forward indefinitely. Over there, before TCJA, it was 2 years carry back and 20 years forward. No, they said no carry back, can carry forward indefinitely, but they put the limit of 80% taxable income deduction, right? But the CARES Act removed that before 2021 because the CARES Act, when COVID happened, so then they said NOL arising in 18, 19, or 20 can offset 100% of taxable income, right? But these are very, very helpful, but those rules are pretty much outdated. I think going forward, you are still would be stick to this carry forward indefinitely subject to 80%, right? And then the concept is excess business loss. Shyama, would you tell us a little bit more on that and what is for the tax year 2022?
Yes, so for the year 2022, the excess business loss concept is for the non-corporate taxpayer. So for example, if a single taxpayer had 1 million of gross income, And he also had a 1.4 million, suppose, losses in active business. So he had like a 400,000 loss, but due to this excess business loss limitation, he is only allowed to use 270,000 of the loss in the current year, because that's the maximum threshold. So it's 270 and 540,000 for a married filing jointly. So the remaining 130,000 he can only carry forward as a net operating loss for the next year, and it can be carried forward. So this basically limits the business loss limitation that you can utilize in a single year.
Right. Okay. Awesome. So this is the concept, and then keep in mind these rules what we're talking at the federal level depends upon the state. Some may not conform to the excess business loss at the state level. So usually to discuss with your tax preparer which state you're in. Most of these
Right,
losses,
especially in those gross income states, they just totally ignore it.
Right. Okay. We are 3 minutes to go, and this is I hope is the fourth question I'm going to launch. Okay, the polling question was that pass-through entry tax is annual allocation and workaround this sort limitation of 10,000. 100% people said yes, so which is correct. So we will have another polling question before we are. I would say that we have another polling question just so people who miss any of the earlier, so they can answer this and can get the CPE. So I'm going to launch another one, the last one. Okay, so the last polling question I had was, what are you hoping to learn more about? And the options were tax strategies for individuals, hedge funds, and businesses. So 60% people said individuals and 35% said hedge funds, and the remaining for businesses. So we will be having another webinar in next week or so, and that will be very focused on hedge funds. So any fund managers who will be involved in that can definitely attend that, and it will be great sharing knowledge. So before we conclude and say thank you to the participants who took a time to attend that, and my my panelists who are delivering this information to you, see what would be your takeaway from this? What would you tell them, taxpayers who are attending that, what they should get one important thing from this webinar?
Try to defer income and accelerate expense if possible.
Okay. Shyama?
Now is the right time to do the tax planning.
Right. Mine is that tax planning is more like a housekeeping thing. You need to have a list of the items ready, because most of the people after the year end scramble things and don't know where their charitable contribution detail is, where their realized gain detail is. So I think it's a good time in December, get ready and do a listing of all the things what you need, and discuss having a schedule meeting with the tax preparer and go with the list if he can come up with a better idea to reduce your tax liability. I would say thank you everyone for joining, and we will be looking forward to seeing you in the future. Thank you.
Thank you.